When you start working in Denmark, understanding how the tax system operates is essential both for planning your finances and for avoiding unpleasant surprises. Denmark is known for relatively high taxes, but also for a high level of public services, and the system is designed to be transparent, largely digital, and straightforward once you understand the basics. In this video, we will walk through the core elements you need to know as an employee. How income tax is structured, what your payslip actually reflects, the role of your tax card, key deductions, and the most important practical steps you should take to stay compliant and optimize your net income. Let's start with the overall structure. In Denmark, employees pay income tax at 3 main levels: municipal tax, state tax, and for higher earners, a top bracket tax. On top of that, you will also contribute to labor market and social security style schemes, but these are typically integrated into the overall calculation of your withholdings. Unlike many countries, there is no separate church tax unless you are a registered member of the Danish National Church, in which case a small additional percentage is applied. The actual percentages vary by municipality, but as a rule of thumb, most employees can expect a total effective tax rate in the range of roughly 37 to 42%, with higher rates applying once you cross into the top bracket threshold. A central feature of the Danish system is the personal allowance. Each taxpayer receives an annual tax-free allowance, which effectively reduces the income subject to tax. This allowance is automatically factored into your tax card, so you do not need to claim it manually. Above this basic allowance, your income is taxed progressively. That means the marginal rate on the last portion of your income is higher than on the first portion. For most employees, the tax they pay is not calculated from scratch every month, but instead withheld at source by the employer, based on information from the Danish tax agency, known as skat. This brings us to the concept of the tax card, or skattekort. When you take up employment in Denmark, you must ensure skat has accurate information about your expected annual income, any other sources of income, and relevant deductions. Skat then issues a tax card electronically, which your employer uses to determine how much tax to withhold from your salary each month. There are usually 2 pieces of information embedded in your tax card: your main tax rate and your monthly tax-free allowance, which is a portion of your annual personal allowance. If you have more than one employer or side income, it is important to designate which income is primary. Otherwise, you risk underpayment or overpayment of tax. As an employee, your payslip is the most tangible expression of how the system works in practice. A standard Danish payslip will show your gross salary, any pension contributions, holiday pay accruals, bonuses, or overtime, and then various deductions such as labor market contributions and income tax. Pension contributions are particularly important. In many employment contracts, your employer pays a percentage of your gross salary into a pension scheme, and you may add your own contribution. These pension contributions typically provide tax benefits, either by being deducted before tax or by being given favorable tax treatment, meaning they reduce your immediate taxable income while building long-term savings. Beyond pension, several other deductions may affect how much tax you ultimately pay. Commuting costs, known as the travel deduction, can be claimed if your daily travel to and from work exceeds a certain distance threshold. Union and unemployment insurance contributions can also be deductible within defined limits. Mortgage interest, if you own property, and certain types of insurance or professional expenses may further influence your tax position. It is usually not sufficient to rely on the default settings. Taking time once a year to review your information in the skat online system can lead to a more accurate tax outcome, and in some cases, a refund. Another critical point is that Denmark operates on a global income principle for residents. If you are considered tax resident in Denmark, typically because you live there on a more than temporary basis, you are generally taxed on your worldwide income. However, double taxation agreements between Denmark and many other countries ensure that the same income is not taxed twice. If you have income from abroad, such as rental income or shares, you must declare it to skat, and the system will then apply the relevant treaty rules or credits. For many employees, especially those on international assignments or with cross-border activities, it can be worthwhile to seek personalized advice to navigate these situations effectively. For employees coming from abroad, a few additional practicalities matter. You will need a CPR number, which is your personal identification number, and you must register with the tax authorities to obtain your tax card. Until your employer receives your tax card, they are legally required to withhold tax at a relatively high default rate, so handling this registration early reduces the risk of over-withholding in your first months. You should also be aware of specific expat tax schemes, which may offer a lower flat tax rate for a limited period to highly qualified international employees who meet strict criteria. If you believe you might be eligible, this is something to discuss with your employer or a tax advisor before or shortly after you start your role, as timing can affect eligibility. From a planning perspective, good practice for any employee in Denmark is to log into the SCAT online platform at least twice a year. Early in the year, you should validate your preliminary tax assessment. Check that your expected salary, bonus, pension contributions, and deductions are correctly reflected. Towards the end of the year, review your actual figures against projections and adjust where needed. This proactive approach helps minimize the risk of a large tax bill or an unexpectedly small refund when the final assessment is issued. It is also advisable to keep basic records, documentation of commuting distances, union payments, pension statements, and any foreign income or tax paid abroad. While the Danish system is highly automated, accurate inputs are crucial. Looking at the bigger picture, the Danish tax system is designed to fund extensive public services, including healthcare, education, infrastructure, and social security benefits. As an employee, your taxes not only finance these services, but also underpin various protections that you and your family may benefit from, such as unemployment insurance if you are a member of an AKC, parental leave arrangements, and elements of the pension system. Understanding this broader context can help frame the relatively high headline tax rates as part of a comprehensive social model. To summarize the key actions, ensure you have a valid CPR number and tax card before or immediately after starting work. Review your preliminary tax assessment on the SCAT portal. Understand how pension contributions and common deductions apply in your situation. And, if you have international income or a complex profile, consider professional advice. By taking these steps, you can navigate the Danish tax system confidently, avoid common pitfalls, and make informed decisions about your net income and long-term financial planning as an employee in Denmark.